In the case of real estate, it's kind of interesting because most assets depreciate in value and we deduct that. And so that kind of makes sense to us. Then we have real estate, which appreciates in value, but we also get this deduction. So super cool.
Welcome into the Get Invested podcast, a podcast about all things real estate and real estate investing, brought to you by Capital Velocity Investments and a part of the Matthias Talks Investing Substack.
Hello, everybody. Welcome into another episode of the Get Invested podcast with your hosts, Jordan and Matthias. And Matthias, it's an exciting day. Now,
got a big one. Got a big one today.
Caught a big one. For those out there, actually, this name might ring a bell for you because her name has rang out across the pages of the Substack newsletter and in conversations on this podcast. It is our CPA extraordinaire. Well, not just our CPA extraordinaire, but CPA extraordinaire Rebecca Cayley, who I was just telling her this, trying to get Matthias to get her on the podcast for about a year, and she's finally here, and we're really excited to talk to her about all things real estate investing, and real estate taxes. Rebecca, thank you so much for coming on the show, and we're so pleased to have you.
Thanks, Jordan. I appreciate it. I'm excited to be here.
All right. Well, before we launch into the hard-hitting questions like what's the most annoying thing Matthias does as a client, why don't you go ahead and tell us a little bit about yourself, your background before we launch in.
We have an accounting firm. We're based out of Florida. We have folks here in Florida and Georgia, so we cross a couple of states. And I've been doing this work for a long time. I started in 1997 in Atlanta, and that's been my deal for now. I guess I'm coming on 30 years, if you will. It seems like yesterday. So we serve primarily small mid-market businesses and individuals that own those businesses, and really working with them from an accounting and tax perspective. Kind of one flows into the other a lot of times, right? But our main priority and goal is really helping them to manage their taxes down. That's everything, kind of our key objective there.
Right. So keeping Matthias out of jail. I get it. Right.
Yeah. Well, he has his own coffee cup at our office, and nobody else does, right?
Wow. I did not know that. Is it?
I love that, man. I love that.
I use it.
Wait, okay, wait a second. Follow up. Did he bring it, or did he use one so much you guys were like, okay, this is just his?
Just his, okay?
Yeah. Okay.
In fact, when I onboard new staff to his engagement, I'm really like, you need to meet Matthias. He comes in, he has coffee, that's his cup, right? That's part of the intro with the team.
Wait, what kind of mug is it? Is it just like a random one?
It's like a random mug. I mean, I think it's like a burnt kind of red color, if you will.
It's like a dark brown kind of.
Sienna.
Dark brown, kind of something like that. Okay. Nondescript, but I'm thinking that we should get him one, right? In fact, we don't have firm mugs. I mean, we need to get one and have him.
You just put Matthias down the bottom.
Maybe I was going to say we'd have his name put on it.
Matthias's mug. You can just
Matthias's mug, right?
Yeah, exactly.
Yeah, well, we love that. We know that he feels comfortable in our space, and that's super important to us.
Yeah, I had no idea. I mean, I knew, as I mentioned, we have conversations about taxes, about you've been in the newsletter. I knew that there was quite the symbiotic relationship here, but I didn't know that there were coffee mug privilege level.
There's shared assets in this this CPA company relationship.
All right, wow.
Let's just say that I spend far more time in her office than I do any other office in the whole business. Property management, brokers, I spend lenders, bankers. I spend more time in the CPA's office. Well, I mean, we have so many different businesses, and they each have their own specific tax situation that we go through. So, but I spend more time with Rebecca and her team than anywhere else, to be honest.
I mean, even your own office there that we're looking at right now, or
no? I mean, there's nobody here besides me, so I can't really say.
Maybe you should just sublet a room
there's some
out of their building.
Some open rooms, I think, in her building. I'll just move over there.
We got some space.
There you go. Is that what that what's the synergy? Here we go.
There we go.
I got to tell you, in all honesty, and I don't know, CPA, some people it's different levels of relationship, right, that we share with our clients. Those that we have that kind of relationship with are the ones that we're really able to add a lot of value to, right? Yeah. And so that those communications, those conversations that we have, a lot comes out of those, right? We learn more about what's going on in the business, and that helps us think about kind of where we need to plan and structure things. So that's super important.
Okay. Well, last question on this before we get into the real questions. Has he ever brought in coffee to replace the amount of coffee that he has drank?
Ooh, I have not.
No, but he's
He
paid
has
for it.
not
He just doesn't know.
contributed to the
Okay,
coffee
we have
class.
it buried in his fees. There's a coffee line. He doesn't see it.
A line item.
Our engagement letters are getting pretty long, so you could get some fun stuff in there, and I'd probably miss it. That's a good point.
Yeah.
There should be like a mug rental fee. And
Sure. Should be a mug rental fee.
All right. Well, let's get a little serious here. Hard hitting questions.
Mm.
We are so happy to have you on. And this is the best time, of course, to have you on as we are in the thick of tax season. And if, by the way, if anyone's listening is surprised that it's tax season, yes, you need to start shaping
Well, first
up.
of all, you're welcome.
Yeah. You got 2 months ish. So, so we're in the middle of it. And so we're going to focus on the kinds of things that our investors might have questions about.
Mm-hmm.
And the first one is one that, because as you well know, we do a lot of work and our main focus and mission is new investors, beginning investors, people who are just getting into this. Maybe they're just getting into real estate. Maybe they're just getting into investing totally. So we tend to have a lot of questions, especially the first time they're filing. And one of those has a lot to do with paper losses. Mm-hmm. So essentially, it's in some version or another of this where they have a little bit of a hard time wrapping their head around the concept of cost segregation studies, how that leads into depreciation and how that depreciation, allows for a declaration of losses and K1s filings and then, those losses moving forward. So I was wondering, what do you think is the best way to explain that whole process and concept to someone who's new to it?
Well, if somebody's new to it, I might change the order just a little bit. And let's just talk about depreciation really quick and kind of lay some groundwork there. And then talk about how that cost segregation work we do around depreciation and planning for that, that then leads to our paper losses, and talk about what that is. So depreciation is a non-cash tax deduction, right? We go out and buy an income producing property. In our case, we're talking about real estate today, but that also could be a piece of equipment or a truck or whatever the case may be, something we're using that's going to produce income for us or our business, right? And when we purchase that asset, that's not a tax deduction at that point. The IRS has special rules that govern that and that say, okay, we're going to let you deduct that asset through what we call depreciation, which essentially accounts for the wear and tear of the asset, right? In the case of real estate, it's kind of interesting because most assets depreciate in value and we deduct that. And so that kind of makes sense to us. Then we have real estate, which appreciates in value, but we also get this deduction. So kind of cool, right? Yeah. Super cool. So we have these special rules that we follow that say, all right, we buy $1 million piece of property, right? We don't take a tax deduction for $1 million piece of property. The IRS says, okay, what kind of property was that? Was it residential? Was it commercial? If it's residential, then we take that over 27 and a half years, and we take a tax deduction on a straight line basis, meaning the same amount each year over 27 and a half years. And that's how we benefit from that purchase from a tax deduction.
I think one of the things that may trip people up a little bit is that the fact that it's both an asset and then there's also a way to declare depreciation. Rather than say it's a truck. It's a little bit more clear when it's equipment, right? It's like, well, I bought a truck for my business. Don't I get to just write that whole thing off? And it's like, well, no, that's not because the truck's doing things for you, right? So then there's a middle ground, which is the depreciation. And I think a lot of people can connect that because they're like, well, my car depreciates. I get that.
Right.
But like you said, the fact that the real estate is appreciating and the fact, especially when we buy, we're going to be probably renovating to improve the property. And the whole point is for the value to go up. That's why they gave us their money. And so they're like, wait a second, we're going down. So
right. We get a deduction for it. And, we use these terms write-off, right? Yeah. And that can mean so many different things. We can dive a little bit more into depreciation to say, well, based on the class life, we may or may not get to accelerate depreciation. We hear this term bonus depreciation a lot. And that's when we kind of equate that to writing off that asset, right? We get bonus depreciation. This is kind of leading into the cost seg study because bonus depreciation, or maybe 179, both of which allow us to have a current expensing of these assets, to write it off, right? Or write off a deduction in the amount equal to our purchase price of that asset. Those are only available for certain class lives. So 5-year class life property, 15-year class life property, 7-year class life property. So the truck, the equipment, a land improvement, right? Those types of things. Those are available for that bonus depreciation or that current expensing. When we get into real estate and we talk about 27.5-year property, which is residential real estate, and 39-year property, which is commercial real estate, those class lives aren't eligible for depreciation, with an exception in the new tax law on qualified production property. We're not going to talk about that right now, but just note there's always exceptions in the tax code. So as we talk through things today, just know that, right? We're talking some general rules, and then there's some underlying exceptions. So this cost segregation study, what it is when you buy this 27-year property, like you guys do, or the 39-year property, the whole purpose is to go in and say, all right, let's kind of break that property apart, right? Let's do an analysis of that property and determine if there's certain pieces of that property that we can put into these other class lives. So for example, the refrigerator, right? You buy multi-unit housing, right? And you might have refrigerators, right? In each of those units. That would be something that we could say, okay, that's not 29 or 39 or 27.5. That is 5-year property, right? When I put it in a 5-year property category through this cost segregation analysis, that enables me to take that accelerated deduction, that current deduction, that write-off, those terms that we think about that allow us for an increased amount of depreciation in the year of acquisition. And or you can do some method changes and take it later. But in general, we're going to talk about the cost segregation study, or cost seg for short, being in the year of the acquisition or construction of that structure.
Yeah, and just to kind of summarize a little bit here. So we're taking that $1 million property that we bought. Let's say it's a $1 million apartment complex. So it's 27.5. That's residential, 27.5 years. Straight line, we'd get to divide. Well, we have to subtract out the land always, because you can't depreciate land. So let's say the land was $200,000. So now we're at $800,000. We either get to divide that $800,000 by 27.5 and take it. Each year we get to do one of those pieces all the way for the next 27.5 years, or we do the cost seg study like what we're talking about, and we divide that 800,000 up to every countertop. And we've talked about this before, but every countertop, every electrical circuit, everything gets assigned a portion of that purchase price. And then everything that falls within the criteria that we can accelerate and move up and write off in the year one, the first year of buying it, that stuff is what the cost seg divides that up. We get to jump it all to the front and accelerate that depreciation and take a huge write-off in the year one. And that's what we talk about. One of the huge benefits of especially residential real estate investing is that you get to offset a huge amount of your investment in, not the whole thing, right? We don't just get to say, all right, $1 million is written off, but a good portion of it, we get to say, hey, we're going to write this off in the year. And in our scenario, that's divided up per investor's ownership. So that whatever the write-off is for the year is divided up according to ownership percentages according to the operating agreement and so on of the property or the LLC that owns the property.
I think you're reading my notes. I had an example here to walk through. It was $1 million.
Reflecting off your glasses, I can actually see them. So
that he doesn't steal your entire thunder.
No, it's okay, man. It's cool.
Let's drill it down to an investor. So you're talking to a single investor, $50,000 they have in this $1 million property, right? I mean, we don't have to do the math on camera. We've tried to do that before, and it usually goes pretty.
It doesn't go well,
but let's just say, right? So if we do 80% of the $1 million, right, and they're 50 of it, we can say, okay, say they can 40 of it is depreciable. What is the impact on them for when they're filing and moving forward? For like, say they invested, it's the year they're filing on the year that they put the investment, right? That they invested last year, they're filing this year. What's the brass tax, if you will, of that?
They invested $50,000, and they're expected. Basically, we're handing them negative $20,000 on their K1. Is that what you're saying? That's the scenario?
Yeah.
Okay. carry on.
So what's going to happen is on their K1, they're going to have a loss item, right, that they get to report on their tax return, right? And whether or not they can benefit from that or not, we're going to talk a little bit more as we get into passive activity rules and talk a little bit about that today. So yes, that becomes what we call this paper loss, right? I think that's where we're kind of headed to is we have positive cash flow in these investments, right? We're making money in this investment, but all of a sudden I see this loss on paper, right? And what does that mean? Well, that typically is driven by accelerated depreciation or accelerated deductions through bonus depreciation or 179 in these cost segregation studies. So you have a loss on paper, but that doesn't mean the investment is losing money, right? That doesn't mean the investment is not profitable. I think that's really important to note. And it's also important to be communicating around those investments as far as the timing of those deductions and when those are going through, right? So, and you typically see that in the first year or so of the investment, right? You see it in the first year, the year after the investment, right? You're going to see those losses flow through. So when you're working with your tax advisor, and as we talk about passive activities, it's really important with these paper losses to line them up with paper income, right? Other investments that you might have that are producing income that are in the same passive category that we're going to drill into maybe a little bit more in our discussion. So as far as, a paper loss, really, it doesn't mean that the investment's not cash flow positive, right?
Right.
It means that they're taking accelerated depreciation by electing. These are methods, right? In the world of tax, we get to choose methods of doing things. And that's really what this is about.
Next year, right? Say, and I'm just going to play the investor here. I made $3,000 in distributions. How is that 20,000 I took the previous year? How does that play into what I'm going to do the next year? Does it have anything to do with what I'm making on the passive end, or is it something completely different that I'm counting it against? Right. So what is it that 20,000 is going to help mitigate down the line? What kinds of income?
Well, so make sure I'm following you. So you're saying, okay, we had a $20,000 loss that came through on an investment structure, right? Now, are we saying, so I'm going to ask you a question back, right?
Okay.
Were we able to take the loss deduction, or was it suspended or limited under the passive activity rules?
Well, since I'm not the tax professional and I'm asking one, I guess you should tell me what are the passive activity rules?
If it was suspended, right, because we didn't have any offsetting passive income, then when you see that investment make money, you kind of hold on to that. It becomes a little bit of a tax. It's not a little bit, but it becomes a tax asset to you, right? A suspended loss. So let's say this is your first real estate investment with Capital Velocity Investors, right? And you have that first year, and you're going to have losses go through. And you go to your accountant, and you're so excited, man. You're so excited, and because you got this loss, right? And you're like, man, this is going to wipe out my tax debt, right? And your accountant said, this is a great thing, and we're super excited for you, right? But you can't take this loss on your tax return this year, right? Don't throw in the towel and call Matthias and Jordan and get upset, right? Because here's what happens, right? You're going to start seeing income come in from that same investment. So the same passive activity that pushed through losses is also going to put through income. And when you have that income, you will be able to utilize that loss from that prior period to offset that future income.
Yeah.
Now, ideally, you're lining up your losses with your income. And that's when taxes are part of your strategy, your investment strategy, right? That's when taxes are part of your investment strategy and you're lining up those items. But when you're just getting into this, right? And I know this because, we made our first investment, right, with Matthias this year.
That's true. I was going to brag about that, but I didn't want to put all your business out in the street. But since you put it there,
it's okay, man. Let's just lay it out there. I finally collected enough pennies. I'm seeing great things happen, and I want to be a part of it. Okay, and I want to be a part of it. So I'm an accountant, right? Investing in real estate is not an active. I'm not actively participating in what Matthias and Capital Velocity Investments are doing, right? I'm a passive investor. Which means when I see losses come through on that first year, unless I have passive activity elsewhere, which means maybe I have some rental property, maybe I have something else that I'm not materially participating in, not portfolio income, and we're going to talk about that. But so we have to be super careful. The tax rules get tricky. but I don't have any other passive investments, then I'm not going to be able to benefit from that loss. I'm going to have to hang on to that asset. We call it a tax asset, right? And I'm going to be able to use that next year. Does that make sense?
Yeah. So that's where I was asking about, like, so if I'm filing next year for say in 2026, this is my only real estate investment. I don't have any other passive income. Let's just make this really simple. Right. I don't have any dividends. And if I do, they're getting reinvested and it's in a tax shelter thing. This is it. This is the only thing I got. So, so it makes $3,000 in passive income in 2026. In 2027, am I claiming some of that 20,000? Am I waiting until it grows? What's the play there? How does that work? Because I think that's where they understand that they're not actually losing money. Right. And I know there's a lot of our investors out there that understand this completely. Let's play the game here. I think maybe one of the things that can trip people up is, okay, I understand that I'm not actually losing money and this is a good thing, but when does it kick in? And it sounds like what you're saying is that when I make $3,000 this year, when I claim next year, some of that 20,000 will come into play. Yes or no?
Let me jump in real quick here, because here's something that it took me a while to learn, and Rebecca probably banging me over the head with a 2x4, but distributions are completely independent of the income being allocated to you. So we could distribute $5,000, to this fictional investor in the, let's say this 2026 tax year. So year 2, let's say we could distribute $5,000 and allocate a loss to them at the same time. They could still have loss. So the depreciation took us below to a negative. So we could still allocate a loss and pay out money. That's they're independent of each other. Now, it doesn't often happen. Usually that's in the very beginning of an investment because we're still accelerating the depreciation and the cash flow is not high enough to bump over into all the depreciation and all the write-offs that we get.
Right.
So just wanted to clarify on that. Yeah. But let's go back to the scenario. Let's say it made $3,000 and you were distributed $3,000 just to line everything up.
Two different things. Right. So I guess I was doing a really bad job playing dumb, because that's what I was trying to get to.
Really good.
We'll never will we? I was gonna say we'll never know, but maybe we do, and I just don't, and everyone else does. But no, that was what I was trying to get at, is that there's the income and then there's the distribution, which are different. So I think that when you're talking, and I'm trying to be like the new investor, right? So when you are that person, you're like, where is this actually going to come into effect? Because I don't have like another massive capital gains thing coming, right, from another sale or from this other thing. Like, so, in a situation like we have with our syndications, just talk them through when this is really going to come to bear. The 3,000, we can do it. Let's just make it the math easy. 5,000 and 5,000, right? The 5,000 distributions don't do anything. The 5,000 income, let's go.
We're allocated 5,000 of income in this second year, moving what we took 20,000 in the first year. That we couldn't benefit from, so we're carrying them.
Right. So we get $5,000 in income in year 2, and we have this $20,000 loss, right? And with that $5,000 of income, we'll allocate $5,000 of that loss to offset that $5,000 in income, right? And so you will net zero, not have any tax implications in year 2. Is that where you're headed with that?
Yeah.
And if I'm not.
Exactly. So, and then I can how long can I carry those losses?
Well, you carry that. The passive activity loss is, I believe, an indefinite life carry forward. I don't think we have a limitation. Some of the losses, we have different types of losses in tax, right? We have net operating losses, all different types of losses and carry forwards. I don't think we have a life on the passive activity, and I apologize that I can't answer that on the podcast.
Cancel episode. Well, guys, we're going to pause. She's going to go look this up.
I'm fairly certain it just hangs out with us until we have passive income that we can use it. Now, and do we have situations that we see clients that have been stuck with passive activity losses that I know they're not going to use? I sure do. And it breaks my heart, man. But we do. We've seen situations where they've been trapped with passive activity losses that, unless they're going to make some investments, they're not going to benefit from, right? And maybe they are, for whatever reason, not inclined to make those investments.
Okay. So I guess, Matthias, the investor may turn to you then at this point and say, okay, well, I was under the impression from the conversation about this property investment that what I would be making, the cash flow would produce distributions until we had a sale. or a refinance. So at what point in this process will I find myself? Remember, this is my only one. Otherwise, I'm just income. I'm just salary. What part of this process will I find myself able to use this?
And my answer to that would be, hey, for one, it's going to protect the cash flow that you get during the life of the investment as long as it carries forward. You know what I mean? That 20,000 could last 3, 4, 5 years, depending on how
That's
the
right.
income is allocated as we go. But additionally, whatever you have left, and we've experienced this with some of our investors on some of our actual property investments, they'll still have a little bit left when it comes time we sell the property and start realizing capital gains. And here's where this is where I get really excited, and Rebecca and I talk about this a lot, is, let's say this is your first investment, it's closing out, you've sheltered pretty much all the cash flow for the life of the investment. Now the property is being sold and you're getting some significant capital gains, and you're going to be taxed on those eventually. Whatever, you use up the last, let's say you use up the last of your losses on that sale, but you still have a decent amount of gain depending on how well the investment went, hopefully pretty well. That's what we aim for. Now we hand you, okay, the cash pays out. Obviously we don't like withhold any taxes, right? We give you, let's say you made $50,000 of capital gains, which is going to be taxed, which depending on your capital gain tax rate could be 50, who knows what the percentage is, but you have $50,000 of expected capital gains that you're going to be taxed on. You could theoretically turn around and invest that in your second investment opportunity, and guess what? You're going to get that year one depreciation loss, and it may not be the full 50,000, right? Like we're talking, hopefully you made more than 50,000 on the deal. You can put whatever you want into it. But now that second deal's passive losses from the year one can help offset the gains from the sale of that first investment, whatever wasn't covered by the initial. And you start building a snowball of tax benefits carried to offset it. Then as long as you keep, like she said, as long as you keep investing, you can keep taking advantage on the back end and on the front end to, and kind of roll them along. And that's what I love so much about the real estate.
I love the way you always say this, Matthias. Do you remember what you say, or do I have to remind you? What is it that you say that you love so much about this investment strategy, Rob? What is it?
Oh, that it kind of works like a Roth IRA.
Yeah.
Yeah,
We've had that episode.
Because you can effectively, and it's not tax-free. Like a Roth is tax-free. So it's hard to get it, but it's very, very tax benefited. If you keep reinvesting your gains from the real estate investments, if you keep investing, you shelter a huge amount and basically defer a huge amount of your tax liability in perpetuity. Because like, for instance, in my personal tax situation, I just know that as long as I keep investing, as we sell these properties, I'm not going to get murdered by one massive tax bill, because I'm going to keep buying new properties and reinvesting in new properties for that depreciation. And I aim to only make investments that look good and that will continue to make money. So I'm not just throwing money out to shield taxes. I'm trying to buy good investments. But that's the whole point, is that I'm able to shelter as we grow, to shelter as much as I can by reinvesting and taking that depreciation.
We have this conversation that you and I, the three of us, just had numerous times with business owners, because they come in and here's the question they ask: how is it that the wealthy don't pay tax, right? And I use that broad stroke statement, and we're not trying to put anybody in any kind of socioeconomic category, right? But they're like, how is it these people can make so much money, right? And they read this in the newspapers and the headlines, and I'm like, well, let me explain this to you, right? And then that's when I give them Matthias's phone number or email, or whatever the case may be. I let him drink out of his mug sometimes, but don't tell him that.
Just to feel special.
Okay, that's a secret between you and me, Jordan. Okay, don't tell him.
Okay.
Anyway,
So,
but no, we do. We have this conversation, and it is an absolutely amazing investment strategy. And it's sometimes hard to take that first step, right? It is. It's sometimes hard to take that first step, but I think once you make that first step and you really understand the benefits and how the mechanics work, that it's really beneficial.
well, I think
That was going to be a perfect segue into the second question, number 4 on the list. But go ahead.
Let's pump those segue brakes real quick.
I don't want to do it too much, because then I'll fall.
Yeah,
forward.
you don't want to fall.
Segues
Yeah. Back to being this investor. Well, Matthias, I thought that the way in which I was going to make money before the sale was in distributions, but now you're saying that distributions don't count against the losses that I'm claiming. And did I misunderstand something?
Nope.
So
Nope.
when am I going to, in this investment, when am I going to make this passive income that would allow me to use these losses other than when there is the sale?
So the inverse is also true. You may get allocated more income. So it's basically ownership income is allocated according to ownership percentages, but that doesn't, like I said, it's not tied to distribution. So let's say we stop distributions because we put a new roof on or something, and we use the money to fund that. There's still income coming from the property, and there you could be allocated income with no distributions. So I'm just saying they're not tied. They're not necessarily tied. So you will be allocated income over the life of the investment if it is a successful investment, and because income should grow to the point where it blows past all the depreciation, everything that's kind of wiping it out. It'll blow past for the whole property, and then obviously you'll be allocated your portion of that income over the life of the property. It isn't tied to distributions. You should be, hopefully you're getting distributions for that same time. But again, that's not the tax benefit. You're not going to get the tax benefit from the distributions. You'll get it from the portion of the income that you're allocated, and it will offset that income.
So I'm going to be reporting that out of all of the income that the property made, I made this amount, even if that is still going to be also pretty much a paper claim.
Correct.
The income itself is going to be a paper claim too, because it's still in the investment.
Mm-hmm.
Okay. All right. I think that's the thing that people get confused about, because they're thinking about money actually coming into the
That's right. Because that's what we think about when we think about income,
Rather
right?
than-
That means I got cash, right?
rather than the fact that you are making money. It's just not liquid and not in your bank account.
Yeah, exactly.
Okay.
It's your
All right, so-
ownership. You own that portion of the income.
Right, you're an investor.
All right. Well, lean forward on that segue. Let's go.
All right. So you talked about taking that first biting the bullet and making that first investment. And a lot of the times a question we get from newer investors is they go, hey, well, I've got a brokerage account with, I don't know, $35,000. I got a couple of brokerage accounts, got a Robinhood, whatever it might be. So, but what I don't want to do is sell all my stocks and have to pay a capital gains tax bill on all that. So you're telling me that if I invest in this real estate investment, it's going to offset those capital gains from those stock sales? And that's where I go, oh boy, here we go. Rebecca, answer.
It gets so tricky, doesn't it? So in the world of tax, the rules that we follow, they put incomes into categories, different types of income into categories, right? We have what we consider active income. We go to work, we have our day job, those types of things are active income, right? Then we have maybe portfolio income, like you're talking about. We have capital gains and losses. We also maybe have interest. We maybe have dividend income. So we kind of have that as portfolio income. And then if we're making passive investments, these are things that we're investing in that are not part of our day job. And real estate has some super special rules around it, right? But when we're investing in those things, then we call that passive income. And when we are determining or calculating your tax or determining what your tax liability might be, we have to keep those buckets separate in certain circumstances, right? There again, there's always exceptions. So capital gains and losses are in its own bucket, right? If you want to think about it that way. And these passive activities, these real estate investment income and losses, if you're not a real estate professional, is in its own bucket, right? And the two can't offset each other. Now, if everything is income, right, then there's no big deal. But when we have losses in one bucket and income in another one, this loss can't offset this income. And that's just the way the rules work. So one of the most misunderstood questions that we have when people walk into our office is understanding. And when we do forecasting, we kind of lay it all out so that you can understand how the different types of income and losses work together. And that's when the planning comes into play, right? Then you kind of understand, all right, if I have a lot of capital gains or whatever, and I need to harvest capital losses, that's what I use to offset that capital gain income. And then in the real estate segment or in the passive activity segment, I'm going to need passive losses to offset passive income.
Yeah, and I hate having that conversation because it's very hard to understand. Just like you said, I mean,
Sure it
you
is.
have to talk about different. I mean, the word buckets is used probably way more than it needs to be, but that's just the way. It's the best way to think about it. But I also tell people is like, look, you're going to have that capital gains tax on these stock, whatever your stock portfolio is. That's going to exist forever and ever. You're never going to escape that capital gain. You're going to pay that now. You're going to pay that later. Whatever. Like you cannot access that money without paying that capital gains tax.
That's correct.
My argument to people, and this is obviously, people need to make their own decisions to do their thing, but my argument is, okay, so do you want to always be tied to that capital gains tax whenever you need the money in your brokerage or want the money, retiring, cashing out, whatever it might be in that brokerage account? Or do you want to start transitioning some of that money from the brokerage account to the real estate, which we already discussed? We can kind of perpetually grow that and alleviate those capital gains taxes. So it's like moving them. Hey, if we can, why wouldn't we move them to the bucket that we can grow relatively tax sheltered versus the one where we can't escape that capital gain? Like the better you do on your Bitcoin or your whatever it might be, you're going to pay, you're going to pay that capital gains tax and cash it all out at once. Then yes, you can absolutely, depending on the size of your portfolio, like you're going to pay. You can have a really bad year one year,
Sure,
even though
you can have a lot in
pay a
taxes.
ton of money.
We have and wealth advisors and they're all really smart, but sometimes we went through a season where they would shift portfolios and create significant capital gain transactions, and the timing of those really matter. They really matter. They can produce some very negative tax results, like you said. But you've got to be thinking about these things in advance because timing is important, right? Timing, so that you can, if you will, if you're moving things out of one particular investment structure and into another investment structure, and you can do that over a season or a couple of seasons, right? Then you're going to minimize your tax implications because we have brackets in capital gains, right? And we have brackets in capital gains, so we can create capital gains with 0% tax rates, right? So that gives you the opportunity to kind of move it into a different investment structure without having any tax implications, right? So there's the ability to do that, but that forethought and planning is really important.
And to kind of just go further with that, when we say timing, like it matters when you sell, because we're basically talking tax year. You don't want to hit certain income thresholds because that will push you into the next either income bracket or tax or capital gains tax bracket, and then obviously you're paying an extra percentage on all the capital gains. So let's say you have, I'm just going to use some random numbers here, but let's say you have $50,000 in a brokerage that you want to move to a real estate investment and for the long-term tax purposes, let's say. Well, it may not make sense to do the whole 50,000 in 1 year. And obviously capital gains are different from the total amount you have and the total value. We're just going to say there's $50,000 of capital gains that you're going to move. It might make sense to do 13 in 1 year because that will keep your overall income for that year below certain thresholds. And then the next year, you don't quite make as much. So maybe you do 24 that next year and so on until you talk with your tax team and say, how much should I move this year versus the next year? Here's my goal. And then you talk to your tax team and they say, well, here's how you do it to minimize your tax burden while you do whatever this goal is you're trying to accomplish.
Absolutely. Actually, just like that, just like you said, right? What he said.
Can you she's trained me well. Talk to your tax team before you do stuff.
What he said, right? And there again, and that matters. So it matters when you have bigger earning years because we have businesses, right? When we serve a lot of business owners and that's their main source of income. And when those businesses, if we're taking accelerated deductions and we have very little income coming out of the business, right? On paper, we talk about paper losses, right? And that'd be a great time to kind of make those moves when we have those other investments.
100%.
So yeah, the timing does matter a lot.
I think buckets is a good way to put it, but I think a way maybe that would make it relatable to anyone, especially the new person who's just now understanding that there are buckets of income. Until now, that meant more like, hey, I got a bucket full of cash rather than like, there's this and then there's this.
Hey, I'm in TurboTax and I can't figure out how to select the bucket.
Yeah, which bucket do I put my money in?
There's nothing wrong with that. You got to learn.
The flip side is the ways in which you can, deductions and right on the other side. Like if you've just done kind of more standard filing, you do understand that, I can take a deduction for charitable giving. I can take a deduction for, when I was a teacher, I could take deduction from spending money in my classroom, or, you can take deductions for. And so it's the same thing. It's like not all the things that you spent money on qualify for deductions. It's not like you can say, well, I paid my heating bill deduction, but you can you can say I paid interest on my mortgage deduction, right? So I think the categories, that part, you just flip it to the other side, but it's more exciting to say, oh, now I have different types of income rather than I have different types of expenses, which is right, obviously a more positive conversation. As much as some may gripe about taxes and avoiding them, it's definitely a much more positive conversation to be talking about how do I not get taxed as much, rather than how do I up the amount that I don't have to pay by saying I spent money on this.
Yeah. So you still spent the money. Yeah, for sure.
Yeah. Well, I think maybe this conversation actually answered the question, that kind of more general one about what's the most common mistake early investors make, or new investors, because I think maybe not understanding the categories of income might be that mistake. So maybe just to wrap it up here, this is a bias question, and we'll just gonna put that out front. But we were wondering, since you deal with this so much, we were wondering what, if any, are the tax advantages to real estate over other types of investment?
Jordan, when you asked that question, when I was thinking about it as we were talking, I was actually looking at it from a different perspective, which is not necessarily investing in a real estate investment, but maybe investing in a piece of real estate, right? And what advantages are there? The tax benefits, we've talked a lot about those, meaning we have the ability to grow income, right? We use the term shelter, and we want to be careful when we use that word, especially in our CPA's office, right? Because they may crawl under the table because we can't use those terms. They get us in trouble, okay? Can't have we're not talking about building a tax shelter. We're talking about taking multiple investments and minimizing our tax implications overall through those multiple investments, right? And
no one's talking about a bank in the Caymans. This is
no,
exactly.
Be super careful with that word, okay? Right? People went to jail over that word. So don't use that word. So that, I think that piece of it, we've really talked a whole lot about, and so that's the tax side of it, right? But there's a lot of it outside of tax that make those types of investments maybe more appealing, if you will, or certainly something that needs to be a part of your overall portfolio, right? Your investment strategy overall, and why you want to have it there. And those are outside of tax, right? And so definitely let's talk about those.
To me, the benefits are, and I will bring taxes back into it because I'd like to talk when I'm comparing types of investments, like investment vehicles. You could do your private equity in a business, private equity in real estate, some of which might be passive, some of which won't be, and then you've got your stocks, your bonds, your equities, currencies, whatever, all these different types of investments you could do. I do like to distinguish, because first of all, you need to know what you're doing, and you need to be able to make a sound investment either way, because tax advantages don't matter if you're losing money on your investments or if you're not making any return on your investment. So you're not going to get taxed, but you didn't make any money either. So that's first of all, you need to know what you're doing. You need to be able to make a sound investment and a worthwhile investment. But what I like to do is I like to compare. Don't invest in real estate for tax advantages.
Right.
Invest in real estate because of the tax advantages compared to the other types of investments that you could do. So, like I said, those capital gains taxes in your brokerage account are always going to be there. You cannot escape them. If you are growing a real estate type investment portfolio, you can not shelter. You can mitigate some of those capital. Yes, offset. There you go. You can offset those capital gains in a way that you cannot compared to a different type of investment. So I like to speak comparatively. Like, that is why I'm so heavily invested in real estate, is because, one, it's what I know. That's most important. And I know how to do a successful investment. But two, when I'm talking, I make successful investments in stocks, and, Jordan and I talk all the time about, oh man, did you see this pop today? Or did you see this tank, or whatever it might be? Somebody announced earnings. We talk and dabble, but I know that compared to those, when I compare the tax consequences of investing and doing well in real estate versus the tax consequences of investing and doing well in stocks, I'm going to choose real estate because I can get better. I can do every bit as well in terms of percentage returns or more, oftentimes more in real estate over the long run, especially than I can in stocks. But I can offset that capital gain income over time and by reinvesting in a way that I cannot do I have to lose money on an investment in order to offset capital gains in a brokerage account, I guess. And that's why when somebody says, why choose real estate over other types of investments, to me, that's why. It's like it's not necessarily that the numbers and the percentages are better, but when compared the whole picture holistically, I think the way to build wealth is in real estate because of all the differences when compared to other types of investing. I guess that's what I like to explain.
I just had one thought that we usually compare this to, say, trying to build a portfolio that is going to grow through primarily growth stocks, maybe some dividend stocks, and build on itself, rollover, compound, etc. But we don't actually have much of a compare to maybe investing in a different kind of business, because in the end, our syndications are businesses, right? So this is a good time to ask this question with Rebecca here. How different, and I'm asking this one genuinely, this is not just like how
Setting
different are the structures of private equity real estate like we do, the syndication, versus, you invest in a business, I don't know, maybe anything. It could be a local one, a restaurant, whatever, that you're like, okay, you have a great idea. I want to pitch in a business that's solid, is trucking along. You throw some money in there. What's the compare and contrast there?
Well, both of those are passive investments, and we see those other investments as well, right? Significantly. In fact, we support some of those structures where, for example, they're going out and buying manufacturing companies and they're vertically aligning those so that they can spin them off, right? Okay. And we have investors in those structures, and we're producing losses, right? Very similar to these, right? And by the way, that's a passive loss. So all the losses we talk about here would align themselves, and with each or the income and the losses, they're both passive. One's real estate, one's manufacturing. I'm an accountant, right? If I'm invested in either one of those two types of activities, those are both considered passive for me. Does that make sense?
Right.
So we've been talking a lot about real estate. So those are all in the same bucket, using that same term. That's right. They're all apples.
Apples. Gala and Fuji maybe, but they're apples. And there's no
That's
orange.
Right. They're apples.
Okay.
They're apples for sure, right? Because they're all passive. And if we want to, so yes, you can have those other investments. Now, when you invest in capital intensive companies, startup companies, they're going to produce typically more losses at the outset. There's a lot of software development companies at the outset. Those are also losses, generally wage-based driven. But so every startup, when you do when you're an angel investor, right? If that's something that you want to do, those types of activities are there again, they're apples compared to the apples that we're talking about today. If that's something that you want, they're structured just a whole host of different ways. You don't see the same cycles that we're talking about in the real estate investment. So kind of the 3-year flip, if you will, or the 5-year flip, where there's some predictability to it, right? In this investment, this real estate investment, when you go put your money into a software development company, there's not any predictability into what that's going to look like, right? You might have some pretty big returns. You may go belly up, right? Right. So we talked about one of the companies we represent, manufacturing company, just been a hard story, big ideas that almost made it, but millions and millions of dollars of passive losses, if you will, and lots of investors in that space. So there's a lot less. I think there's more risk, right? Much more risk when you're talking about investing in those types of startup activities, and less predictability on returns. Much less predictability on returns. Real estate investments, same concept. They're your investment, and you're investing in something that's a passive activity. So they're again apples, but you have predictability, particularly. And just to make a plug here, with the work that you guys have done at CVI, because you have a proven track record, right, with your real estate investments and what those have looked like, right? Consistency. And I think that's really important. And that gives new investors like myself a lot of confidence in the work that you do, right? And that's really important. I also want to just kind of segue something else in here, because I wanted, I'd kind of prepared some notes around investing in a piece of real estate, right? But there again, let's use me as an accountant, right?
Sure.
So let's say I've got Matthias's investment with Capital Labasi Investments, and then I decide to go buy a piece of property and treat it as rental property, right? We are apples and apples, but I own that property, right? And instead I'm an investor in Matthias's syndicates, real estate syndicates, or CVI's real estate syndicates. But in this investment, I actually go and buy the piece of property, and I'm going to have short-term rentals in it, right? Because I live in Destin, and that's what we do. We do short-term rentals, right? There again, I'm going to get some of those other tax benefits that we talked about, the depreciation, the cost seg, and all the good stuff. Having this asset that I can control, this large asset, if you will, that's going to generate income and still have tax losses or paper losses. And I can marry that activity with my real estate investment with CVI. Does that make sense? So there again, apples to apples. That's another passive activity, and that's part of your overall planning structure.
That's good to know, because that's I can see fielding questions like that. That's actually something that I've escaped it because my wife's been a real estate agent for as long as we've been doing this. So we've counted, even when I was active duty, we've counted as real estate professionals according to the IRS code. So we've never had that question. When we started buying rentals, the single family houses, just by ourselves, we already qualified as real estate professionals. So it kind of made that point moot. Everything's apples when you're real estate professional on real estate side. So that's good to know. I actually did not know that. So I learned something here today, that if you buy your own rental on the side, it is, you got the apples bucket. The bucket of apples is still intact.
Apples. We've got a bushel of
I like
apples,
that.
guys. They may be different.
I like it.
Just a bushel of apples. Matthias touched on just a moment ago the real estate laws and when does real estate become an active income, ordinary income, right? Day job income. And there are special rules around that. What you want to do is you're saying, okay, now how can I take that passive income and make it ordinary income? Because we don't get special tax rates with passive income, right? It's just a different category. And we want to be able to marry it sometimes with our ordinary income and losses, right? So how do we turn that from a passive investment into an active investment? And there's special rules.
This is a matter near and dear to my heart. But we've kept you long enough, and we're getting up on an hour here we're probably taxing the patience of our listeners. Look at me go.
That was great.
It's been a lot
All right,
of fun,
well, we
though.
really appreciate Rebecca joining us. Well, it was a great conversation. I hope you guys learned a lot. I mean, my one last note would be there's no need to go buy that rental on the side. Just invest in another CVI property.
Amen.
Lot less work.
It is less work. You don't have to find renters, right?
Stay truly passive, okay? There's some activity in being your own landlord. But I had a great conversation. I hope you guys got a lot out of that. I know we did. As always, if you want to reach out with questions, comments, thoughts, prayers, etc., you can comment on the Substack, comment on the YouTube, comment on Spotify, DM us on LinkedIn, shoot us an email at Matthias or Jordan, capitallossinvestments.com. Or as always, you can hit up that chat bot on the website, capitallossinvestments.com as well. Otherwise,
real quick, Rebecca, what's your website?
Yeah.
Our website is www.testutaylor.com.
Cool. We'll link to it as well.
Yeah, we'll put that in the show notes for sure. That's a mouthful there, so we'll make sure to put it there so everybody can find it. Absolutely.
The family name, it's just a lot of things is what it is.
All right. Well, as always, we appreciate you guys hanging out with us, and we hope that you will come back and hang out with us again next week on another edition of the Get Invested podcast.
See ya.
Thanks so much.